Welcome everybody to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group Securities offered by MoneyBlock. I want to go over a couple strategic approaches that a lot of new options traders utilize as their first sets of trades. But I want to give you some parameters and some guidelines. And for those of you that are not options traders, you're investors, whether you're investing for yourself or you're thinking about maybe doing a little bit of self-investment, self-directed investment, I'm going to give you some guidelines on how you can utilize options a lot more strategically and much more prudently. Let's take, for example, a stock that just announced earnings last night, Amazon. Now, Amazon's a $929 stock. After earnings, the stock was up like 60, 70 bucks. It's now trading up $10 on the day, but it basically has a $1,000 price target, if not more. With that being said, people are like, well, just to buy one share, I have to put up $900. That's one share, not 100, one. If I buy 100, I have to put up 92,000. Well, most of us don't want to do that. That's where we start to get introduced to the world of options. So if I go down and I look at let's say the expiration in May, that's happening in about 20 days. The stock is trading right now at $928. So the closest strike to where the stock is trading is $927. Now a strike price is just quite simply the price in which you are negotiating, or in other words, if you buy the option, that's the price in which you are going to be either long or short shares. And in this case, we're looking at the $927.50 strike. So it's basically right near where the stock is trading at this juncture. We call that the at-the-money strike. Now, this gives you the right to be either long in the case of buying calls, the stock, or short in the case of buying puts. Those are the two options that you have, puts or calls, at the strike price, or in other words, the stock price of $927.50. Now, just like an insurance policy that you would purchase out in the open market, this is an option to be either long or short the market. So you're going to pay a premium, right? This is the old analogy of insurance, but that's it. Enough with the insurance analogy. For that, you pay a premium, in this case, of $16.70 if you want to go long, or in other words, buy the calls, or if you're negative and you want to go short or have a bearish position, you would buy the puts, and that would be at $14.88. So today we're just talking about buying calls and buying puts. Now, what is your probability of potentially being successful? Well, that's where I look at a term called delta. That's this column here, delta, right here. Okay? And delta, all delta is telling me is that there is a 52% probability that between now and May expiration, which is in the next 20 days, that this $927.50 strike call option will be in the money at expiration. That's a little bit better than the odds that you get when you're flipping a coin of either heads or tails. So it's a 50-50 proposition. Now, of course, you only have to put up basically $1,670 to have the right to own 100 shares of this stock at $927. Or in other words, you only have to put up a small fraction, right? Otherwise, you'd have to buy it at $92,750. Or if you were going to sell it, in other words, short it outright, you'd have to put up that risk premium. So, one thing that you should be understanding here is not only can you use options for leverage, but when you look at the term delta, this gives you a probability of whether or not that option will actually be potentially profitable. Or in other words, have the potential to be profitable. The higher the delta, the higher the probability that the option will be in the money at expiration. So if you're buying options and you have a higher delta, that's telling you that you're having a higher probability at expiration to have this option be in the money. Now, will it be profitable? No, not necessarily. you have basically at this juncture a 50-50 chance that the stock is going to be at or above $927.50. So that's why I always, as I start to discuss buying options, we're always going to look at something that has a higher probability of potential success. We're going to look at deltas when we're buying options that are a little bit higher. That means that we're going to have to pay more money, but because we're paying more money, we're getting a higher probability of potential success. Yes, we're taking on more risk. Yes, we may have to purchase less contracts, which, by the way, size is what kills. But if I have an opinion of being either bullish, I'll buy calls, or bearish, I'll buy puts, I'm going to buy something that has a higher probability of success, which means that that delta is going to be a gauge that will help me understand, do I have a higher probability of success of buying the $917.50 calls? Do I have a higher probability of success buying the $927.50 calls? Or do I have a higher probability of success of buying the $935 calls? If you look at this, you have a 44% probability that the stock will be above $935. You have a 52% probability that the stock at expiration could potentially be above $927.50. And you have a 61% probability that the stock will be above $917.50. So which one sounds like a better proposition? Well, probably the $917.50 call, strike call. But the put, if you scroll over and look at the delta on the put, you'll see that the delta on the put is 43 on the $917.50 put. So puts are the direct opposite of calls. These are out of the money. These puts, that call, the $917.50 call, is in the money. So really you can use options not only for leverage, not only to have fixed risk, because when I buy an option, whatever I pay for it is my risk, but you can also use options prudently by paying a little bit more for something that has a little bit higher probability of potential success, or at least being in a opportunity, giving you a better opportunity of being in play as you get closer to expiration. Now, join us on future segments and strategy now, where I will go over how you can spread some of this risk off, where instead of just buying this option here, I would sell maybe this option here, the 932.5. That'll offset my purchase price by the amount that I sell it. So in other words, instead of just paying $23.75 outright, I'm going to pay $23.75 and subtract $13.55 from it. Now there are give-ups on that, but I'm reducing my capital risk in that particular strategy, and that may be better for my risk tolerance, my objectives, and it may actually be improving my probability of potential success. All right, folks, that's it right now for Strategy Now. Join me this afternoon at 3:30 Eastern Time. That will be 2:30 Central. I'm going to be going over Tech Talk. I'm going to talk about what we can expect for the next moves going in the next week, and the S&P 500, the NASDAQ, the Russell 2000, and the Dow Jones. I'll cover all four of the major indices so that you can start looking at what you could expect for potential movements in those underlying indices next week. So we'll see you then here at MarketStream.live.